Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com.
Today we're going to talk about John Anthony Castro. John Anthony Castro was a tax professional. He would advise U.S. taxpayers on a number of different transactions. The problem is that Mr. Castro was recently convicted of defrauding the United States government and sentenced to over 15 years in prison. Now, Mr. Castro literally had hundreds, if not thousands, of US based clients. And that leaves all these clients in the lurch. What do they do now? A lot of Mr. Castro's former clients have taken positions on their tax returns, thanks to Mr. Castro, that are questionable and could be subject to scrutiny by the IRS. And if the IRS were to go and look at some of the tax returns that Mr. Castro has prepared for his clients and disallow some of these transactions or disallow some of the deductions that are taken on these tax returns, it could cost the person who was the former Castro client thousands of dollars in back taxes, interest, and penalties. So let's talk about some of the transactions that Mr. Castro has prepared or has advised his clients to take on tax returns that are questionable. And when I'm going to be talking today about the transactions that are questionable, this is based on my experience. I have quite a few former Castro clients that have come to me, and I advise them on how to go ahead and prepare amended returns or how to go ahead and make disclosures to the IRS of transactions that are suspect. So one of the areas that are probably the most suspect that I have seen that Mr. Castro has advised clients to do or has basically prepared tax returns in a certain way is with Schedule Cs. What Mr. Castro did is that he wound up attaching Schedule Cs to his tax clients. The Schedule C is basically used by a taxpayer to report business income and business expenses. Well, what Mr. Castro did was he wound up advising a lot of his clients to take a number of very suspicious deductions on Schedule Cs that may or may not be legitimate. And a lot of the expenses that were claimed on Schedule Cs were for groceries, for commuting expenses to places that were not legitimate, were for taking improper deductions of home expenses. Now, if left alone, there's a pretty good chance that the IRS will go ahead and catch these Schedule C expenses and potentially could go ahead and disallow these deductions in a future audit. And if these expenses are disallowed, the IRS can go ahead and assess some significant penalties to the individual that wind up taking these positions on the tax return. So if you are a former Castro client, or if you had your tax returns prepared either by Mr. Castro or by his affiliated tax preparation firm, which is aitax.com. And if you had a Schedule C prepared by Mr. Castro or his related tax firm, have a professional take a look at those expenses that are taken on that Schedule C. And if those expenses are suspect, you probably want to go ahead and amend the return to make sure that those expenses that are not legit are taken off the return. Now, another area where Mr. Castro wound up taking a pretty aggressive position when it comes time to take a filing position on a so-called superannuation fund. A superannuation fund is something similar to a 401k plan in Australia. The problem is that it doesn't qualify in the US as a deferred compensation plan. So if you wanted taking a distribution from a superannuation fund, and let's just say you're a US person and you have it, it's not going to be treated the same way here in the US as, say, a 401k would be or an IRA would be. What Mr. Castro wound up doing is Mr. Castro took a very creative position. And Mr. Castro wound up looking at the US and Australia income tax treaty. Now, the US Australia Income Tax Treaty, specifically Article 12 of the treaty, there is a provision in there that allows for an exclusion of income that can be classified as Social Security to be excluded from U.S. taxation. Now, what Mr. Castro did is he said, look, I'm going to go ahead and classify a superannuation fund distribution as if it were Social Security and take a treaty position to exclude it from U.S. taxes. That's a pretty aggressive position. There is no case law that backs that. Now, what Mr. Castro did, he said, look, there is a so-called totalization agreement between the United States and Australia. What a totalization agreement is, it's somewhat like a tax treaty, but it's for Social Security income. And the totalization agreement mentions the Australian superannuation fund, but it doesn't go ahead and specifically state that it's Social Security income. So with there not being any cases out there and there not being any tax law out there that one can rely upon to take the position that a distribution from a superannuation fund is Social Security, you can wind up having a situation where the IRS could reclassify that treaty position. If the IRS reclassifies that treaty position, you can wind up being subject to fairly serious penalties. Now, how is that income classified in the US? If it's not classified as Social Security, what do you classify it as? Well, one way it can be classified is a flat-out distribution from a foreign retirement plan. And there's a number of different ways that can be treated. One, the entire amount could be subject to tax. Two, an allocation can be made between the time that the individuals gained the distribution was a U.S. person compared to when it was an Australian citizen. So you might be able to exclude some of it. It all depends on specific facts and circumstances of each case. There's another way that this could be treated as, and it can be treated under the so-called Passive Foreign Investment Company Tax Rules, or PFIC. And what PFIC is that if you have a foreign mutual fund, what the IRS does is that it taxes it very harshly. And namely what the IRS does, it assesses a so-called throwback interest on the holding period while the U.S. person held a mutual fund, a stock through mutual fund, and it winds up eroding away the mutual fund eventually to the point in time that it winds up going down to nothing. Now, why am I saying mutual fund? The problem is that a lot of superannuation funds contained mutual funds. The idea of the superannuation fund was to kind of go up in value over the years, and then when someone winds up retiring, the account greatly grows. So the thought process is that if you have a mutual fund or mutual funds being held by a superannuation fund, you could wind up having greater growth. That works fine in Australia. Doesn't work so well in the US. Is there a way that this really harsh tax liability could be mitigated? Yes, there is a way. It depends on the specific facts and circumstances of each case. Sometimes you can make what's called a qualified electing fund election. Sometimes somebody can make an election under the so-called mark-to-market regime. In either case, you could wind up potentially mitigating the tax impact of a distribution from a mutual fund that was held by a superannuation fund. But you should definitely have a qualified tax attorney take a look at the contents of the superannuation fund to make a determination on how to best tax it. Now, not only do we need to be concerned about the tax consequences of a superannuation fund, but there's a number of reporting requirements. Whenever a U.S. person holds foreign assets, those foreign assets are subject to a number of reporting requirements. And what I mean by reporting requirements, there's specific forms that have to disclose that foreign asset onto the IRS. And if that form isn't filed with the IRS timely, there is some pretty steep penalties that could wind up being assessed against the owner of a foreign financial account that didn't disclose it timely to the IRS. What are the specific forms that a superannuation fund needs to be disclosed upon? Well, one, there's something called an F-bar. An F-bar is if you're a U.S. person, in this case, let's just say you are an Australian expat, You're in the US, you wound up becoming a US person, either because you just got your citizenship or you have your green card. As a US person, you have to disclose your foreign assets on a number of these forms. One of these forms is as an FBAR, as I was alluding to. What is an FBAR? If you have a foreign financial account that is worth more than $10,000 each year, that has to be disclosed on an FBAR. If you don't disclose it on an FBAR timely, the IRS could assess a minimum penalty of $10,000 per year for that superannuation fund that's not disclosed on the FBAR. I've reviewed a number of returns that was prepared by Mr. Castro. Universally, what I've noticed is that the superannuation fund was not disclosed on an FBAR. So if you have a superannuation fund and you had Castro prepare your tax returns, definitely make sure that that was reported properly on an FBAR. There's another financial form that a foreign asset needs to be disclosed on. The form is called 8938. A form 8938 requires a disclosure of a foreign financial asset. It's a sliding scale, goes anywhere from $50,000 to $150,000. That depends on the length of time that the person is in the US, whether they're married or not. But I will say that a superannuation fund needs to go on an 8938. When I reviewed a lot of the returns that was prepared by Mr. Castro, I did not see the superannuation fund disclosed on an 8938. Failure to report a superannuation fund on an 8938 can result in another $10,000 penalty per year. Now, some superannuation funds can be classified as foreign trusts for U.S. purposes. If a superannuation fund can be classified as a foreign trust, particularly a grantor foreign trust, that superannuation account needs to be disclosed on an IRS Form 3520 and an IRS 3520A. Penalties for not disclosing a superannuation fund on a Form 3520, 3520A are astronomical. If you do have a superannuation fund and you do not, and it was prepared by the Castro firm, and you do not see that was disclosed on a Form 3520 or 3520A, definitely seek the advice of a competent U.S. attorney to make a determination whether or not that superannuation fund should be disclosed on a Form 3520 and 3520A. And finally, if the superannuation fund contained a mutual fund, then the superannuation fund needs to be disclosed on a Form 8621. Now, there's no penalties for not disclosing the superannuation fund on a Form 8621, but the problem is if you don't disclose on 8621, you're leaving open yourself to an IRS audit into perpetuity. Because if you don't go ahead and disclose the superannuation fund on that Form 8621, the time period that the IRS has to audit your tax returns never expires. So if there is a mutual fund that is inside a superannuation account or fund, they have someone take a look at it, make sure that if there's an 8621 that needs to be filed, it is filed at the Internal Revenue Service. So you begin that clock running for purposes of the IRS having their ability to audit your tax returns. Besides Schedule C and the superannuation fund, there is one other area that I have noticed some problems when Mr. Castro or the Castro firm prepares a U.S. tax return, and that's with the Schedule E. A lot of Mr. Castro's clients, they have rental properties throughout the world. What I have noticed that in some cases, the depreciation schedule itself is not prepared correctly for foreign rental property. And if you have foreign rental property, you had Mr. Castro prepare your tax returns, make sure you have a qualified tax professional. Take a look at your returns to make sure that the depreciation schedule is properly reported. The reason you want to have this done is you want to make sure that you're getting the best tax benefit that you can. That's within confines of law when it comes time for taking a depreciation against rental income. So as with any situation, when you're having someone look at your tax returns or you're seeking advice on a foreign transaction, make sure that you seek out a qualified tax professional to look at your tax returns or advise you on any kind of foreign transactions that you are considering in the future. As always, this is not intended to be legal advice or tax advice. If you have an issue with your tax returns, or if you have a question regarding a tax position that Mr. Castro advised you on, seek the advice of a qualified tax attorney. This is not meant to be an attorney-client relationship. This is not an invitation for an attorney-client relationship. Make sure that you go ahead and you consult with a qualified attorney as soon as possible.